The Canadian government is trying to prop up the housing market, and it has major implications for buyers and sellers of real estate in Canada. So make sure you watch to the end of this video, because I'm going to show you how capital gains tax is going to change the market. And I'll give you 2 actionable things that you can do to get the best deals in the market before and after the capital gains tax increases in Canada. And it's 2 different strategies, one for before, one for after. So you'll learn how to find the best deals based on calculating a seller's capital gains exposure. And 2, you'll learn how to use a vendor take-back mortgage to negotiate better deals with sellers, because you'll be helping them by spreading out their capital gains income over 5 years. So today I'm going to be talking about how the Canadian government could basically be doing yield curve control on CMHC mortgages and operating in almost modern monetary theory principles that directly pump money into the real estate industry, and that the capital gains tax policy is actually an inflation control, even though they might not even know that. So I put together this article on Substack that basically describes the capital gains tax policy and why I'm fascinated by it as a policy decision, mostly because I think that it's a further step towards a framework of modern monetary theory in Canada, whether or not it was done deliberately. There's 4 key points here. Number 1 is the government is trying to keep CMHC interest rates low through de facto yield curve control, which I will describe in a bit. Number 2, capital gains increase would serve as a wealth redistribution tax in the context of modern monetary theory. Not sure whether or not they're actually following the principles of modern monetary theory, but it's starting to look like that, and I'll explain that with a cool visual. Number 3, you should be able to get good deals on real estate before the 25th when the capital gains tax comes into play, and for after the 25th, you should know how to use a vendor take-back mortgage as a real estate investor if you want to get better deals. So modern monetary theory provides this different perspective on the use of fiscal policy. It basically states that governments who create their own currency and they spend and tax that currency, they can issue any amount of currency that they want in order to stimulate the economy. So in this scenario, you would stimulate the economy, you would spend money to stimulate the economy. Then that money would economize. It would be out in the economy, making money, earning a return. And then you would tax that money back out to redistribute it. And the clearest indication of this taking place in Canada is through housing and real estate. So real estate, if I was the government, I understand why they would want to do it in real estate, because in Canada, we have a high amount of exposure to real estate as an investment. In Canada, residential investment is a major part of our economy. You can see it diverging in Canada from the US here. So CMHC has basically started, so the government of Canada has basically used CMHC to issue $20 billion more in Canada mortgage bonds. You can see this on their website, Government of Canada unlocking $20 billion in new financing to build 30,000 more apartments this year. So they're claiming that the money goes exclusively to CMHC MLI Select financing, but the reality is it's the same capital pool as the other CMHC, and so the issuance increases the entire CMHC capital pool, regardless of what the outcome of that capital is. And similarly, their ability to buy all of these mortgages. So not only are they issuing $20 billion more of CMBs, they're also going to become the primary purchaser of them. So the Canadian government will be buying 50% of all Canada mortgage bonds. And so what this does is it allows them to keep the insured mortgage significantly below the conventional mortgage. So you can see here the 5-year conventional mortgage index versus the 5-year insured mortgage index. The spread on the insured is significantly lower because obviously lenders take on way less risk in this scenario where the risk is insured by CMHC. The banking industry pitched this strategy to the government of Canada. There's a summary of it on the Bank of Canada website. Basically, there's some comments received in the consultations where they basically outline that the government of Canada should sell their bonds at, let's say, 4%, and then use that money to purchase Canada mortgage bonds at 4.5%, and they would pocket the difference. They would make a spread of 50 basis points in this scenario. So they would make money. It's a revenue generating exercise. And that's true. Totally true. It's a good revenue generating exercise for the Canadian government. So now we're at the point where the Canadian government is the biggest buyer of Canada mortgage bonds in the world. And because they're buying half of the Canada mortgage bonds, they are able to set the price of those bonds, which means that they're able to set the rate of the insured insured mortgages, which are based on the Canada Mortgage Bond. So all of this to mention that this would be sort of the stimulus portion of what I would call modern monetary theory in Canadian real estate. So there's a great little visual here that I have on the screen beside me that shows modern monetary theory. This comes from marketplace. The faucet is government spending, the water is the money, and the overflow is inflation. This is when we've seen house prices accelerate as a result of record low monetary policy, record low interest rates from monetary policy. That would be another similar example of government policy that can cause inflationary impact. This isn't the first time they've targeted owner-occupied or first-time buyers. They did it very clearly with the extension, the 30-year amortization, which I've covered in another video. And it makes the most sense to use policy to stimulate the first-time home buyer, especially because according to the Bank of Canada, and if you just Google Bank of Canada first-time buyers as a percentage of total, you can actually see this article, Housing Demand in Canada, and they show quite a few great charts here, but the most important one here shows that first-time home buyers are almost 50% of the total. And I've showed this chart a couple of times, so I'm not going to belabor it. The next piece that I want to look at is what happens in modern monetary theory when you want to get rid of that inflationary impact of the spending, which obviously is an objective of the government right now. Taxation can be a regulatory tool in modern monetary theory. It can be used to redistribute the wealth, which we know is a clear policy objective from the government of Canada right now, where they've made it clear that they are targeting real estate wealth or wealth in this capital gains tax addition to the budget. They can use it to encourage or discourage behaviors, so incentivize or disincentivize certain economic decisions like housing, fossil fuels, alcohol and tobacco consumption, all of which are taxed similarly, but that's another story. And they can use it to sustain demand for currency by requiring taxes to be paid in a government's currency. MMT argues that this ensures a continued demand for that currency. So, and this is an interesting one. That taxation piece is interesting, and the demand is interesting because we are at risk of the Canadian dollar being devalued against the US dollar if the Bank of Canada cuts before the Federal Reserve. So stacking this tax idea on top of the visual here that we had from marketplace.org, we have the faucet, which is the government of Canada spending on mortgage bonds. We have the water, which is the money being used for mortgages. We have the sink stopper, which is an increase to the capital gains policy. So that's you moving the drain. And then the drain itself is the tax revenue earned from increased capital gains tax. So we've seen this modern monetary theory concept come full circle for Canadian real estate in such that you now have an environment in which this money's been pushed into housing and will continue to be pushed into housing. It can economize in housing. It can pay for renovations, which we just saw is the primary reason that people are refinancing. Funding renovations is one of the primary reasons that people refinance. So this is that money being pushed into housing that's helping to fund contracting companies or other members of the economy. So what does this mean for us, real estate investors? To me, this means that there's a decent chance that we end up seeing what I would call a K-shaped recovery in Canada, which means that some of the parts of the economy will recover faster than other parts of the economy after we see our next recession in Canada. And so the green line in this scenario being the housing asset and the purple line being the remainder of the economy. I would hope that the Canadian government will eventually diversify the Canadian economy so that all portions of the economy will recover faster than the housing economy. And by and large, the housing economy is very much in a recession right now, with real estate transactions being their lowest 2 years, basically, that we've seen since like the last crash in housing, which was in the 1990s. So very quickly, I did some calculations on sort of what you can expect and how you can maximize this opportunity that capital gains is coming in on the 25th. So before the 25th, I want you to, and I put a tweet out about this. It says how to find the best deals in the market in the next 45 days. Find a corporately owned property. Step 2, find out what the seller paid and deduct it from the listing price. So you can either do this if you're a real estate professional, you can look it up on the land registry, or if you are an individual, you can ask a realtor to look it up for you on the land registry. Number 3, estimate their current capital gains tax. So figure out based on that, what you would estimate their capital gains tax to be, and then estimate their capital gains tax after June 25th and offer them a price with an equivalent discount to close before the 25th. They would either be giving the same amount of money to the government as they would be giving to you as a discount. So in an example I put in here, the person paid $1 million. The house is now worth $2 million. Their capital gain was $1 million. So and assuming an income tax rate of 52%, their capital gains inclusion before was 50%. Their capital gains inclusion after is 66.67%. Their capital gains before was $260,000 and their capital gains after is $346,000, leaving a difference of about $86,000 that you could offer. If you offer them $75,000 below asking price, they're still ahead. So that leaves us with the best strategy to capitalize on this before the 25th, which is coming up very quickly. Like, it's a month and a half away. What is the best strategy after the 25th? To me, the best strategy after the 25th is using a vendor take-back mortgage. So on smaller properties, using a vendor take-back mortgage or a VTB will also help you to negotiate a better price, because the owner can do something called a capital gains reserve, where they can basically sell the property and then spread out the capital gain over 5 years after they've sold the property by giving you a vendor take-back mortgage. So they're basically, if they're giving you a 5-year term, they're collecting that capital gain over the next 5 years. They can only do it up to 20% per year. And so what this would do is, if somebody had a capital gain of, let's say, $500,000, it would put them in the top tax bracket. If they spread that out into 5 $100,000 increments, then it would knock them down into the middle tax bracket. So this is something that I would highly encourage you to not take my advice for, because I'm not an accountant or a tax professional. But when you're making an offer on a property after the 25th, ask your tax professional or accountant to help you put together a proposal on what this would look like for potential sellers, so that you can explain to them very clearly in writing or in a spreadsheet how much money you're going to save them by giving them a vendor take-back mortgage, or them giving you a vendor take-back mortgage. And that's before you even account for the amount of money that they'll make from you paying them interest. So I hope this was exceptionally clear. I also posted a written version of this on my Substack, and if you are interested in learning more stuff like this, I would encourage you to join our free community at realist.ca. We have monthly webinars. One of the next webinars coming up is actually going to be on doing these vendor take-back mortgages, structuring them. So you'll need the help of a mortgage broker to draft the commitment, and you'll need the help of an accountant to help you figure out that cost. We have hundreds of hours of content just like this on our premium school group, which has a classroom tab here and a very full calendar of regular calls, including masterminds and deal workshops, as well as running the numbers and group coaching calls. So if you enjoyed this and got value from this, I think you would be a great fit for that community. We'd love to schedule a call to see if you think so too. Make sure you click the top link in my YouTube video description to do that. And as always, please like, comment, and subscribe to this video. I always like having thoughtful comments. I like having discussions with people about this stuff. I like being wrong and being told why I am wrong. I like changing my mind. So I welcome any thoughtful conversation in the comments. Thanks. And I'll see you next week. I think I've been pretty good about putting these out on a weekly basis, which is great.